Hello and welcome back to MoneyMasterMind. Today, we are exploring the most common mistakes you should avoid to secure your financial future. Now let's get started. But first, if you enjoy this topic or anything about investing, be sure to like and subscribe for more videos like this. Now, let's get straight into it. The journey of investing can be both exhilarating and daunting, especially for beginners. It's a pathway toward financial freedom, wealth accumulation, and securing a stable future. However, in the excitement of potential gains, it's easy to fall into common pitfalls that could jeopardize your investments. In this guide, we'll explore the necessary principles every new investor should understand to navigate the world of investing. From the importance of taking that initial step into the market to portfolio diversification, we'll uncover the key factors that can make or break your investment strategy. By steering clear of these common mistakes, you'll not only safeguard your hard-earned money, but also set yourself on a path towards long-term financial success. Whether you're a recent college graduate looking to start investing for the first time, or a seasoned professional seeking to refine your investment approach, or if you are in high school, this video is designed to equip you with the knowledge and insights necessary to make informed decisions. So grab a pen and paper and let's begin this journey together to unlock the secrets of successful investing and secure a brighter financial future. One of the most significant mistakes beginners often make in their financial journey is simply not investing at all. While it's understandable to feel apprehensive about entering the world of investments, failing to take any action can have detrimental long-term consequences for your financial well-being. By keeping your money idle or solely relying on traditional savings accounts, you miss out on the potential for wealth accumulation and financial growth that investing offers. Inflation gradually eats away at the purchasing power of your savings over time, meaning that money left untouched may actually lose value in real terms. This highlights the importance of putting your money to work through strategic investment decisions. Investing provides an avenue for your money to grow over time through the power of compound interest and capital appreciation. Whether it's stocks, bonds, real estate, or other investment vehicles, each offers its own potential for generating returns that outpace inflation and build wealth over the long term. Also, investing can serve as a hedge against future financial uncertainties, such as retirement planning or unexpected expenses. By allocating funds to diverse investment opportunities, you create a robust financial portfolio that can withstand market fluctuations and provide stability in times of need. While the idea of investing may seem daunting, especially for beginners, taking that first step is crucial for securing your financial future. Whether you start small with a basic brokerage account or seek guidance from financial advisors, the key is to begin investing and let time and compounding work in your favor. By overcoming the obstacle of not investing at all, you open the door to a world of financial possibilities and pave the way toward a more secure and prosperous future. Another critical mistake beginners often make when diving into the world of investing is neglecting to establish an emergency fund. An emergency fund serves as a financial safety net, providing you with a cushion to fall back on in times of unexpected expenses or emergencies. Without this buffer, you may find yourself forced to liquidate your investments prematurely, potentially incurring losses or missing out on long-term gains. An emergency fund typically consists of liquid assets, such as cash or easily accessible savings, equivalent to 3 to 6 months' worth of living expenses. This reserve can cover unforeseen events like medical emergencies, car repairs, or sudden job loss, allowing you to weather financial storms without disrupting your investment strategy. By prioritizing the establishment of an emergency fund before investing, you secure your financial stability and position yourself for success in the market. It acts as a shield, protecting your investment portfolio from being prematurely liquidated in times of crisis. The absence of an emergency fund leaves you vulnerable to unexpected setbacks that can derail your financial goals. It provides peace of mind, knowing that you have a financial cushion to rely on when life throws unexpected challenges your way. So before you allocate your hard-earned money into investments, make sure that you have an emergency fund in place to protect yourself against unforeseen circumstances and set a solid foundation for your financial future. By establishing an emergency fund before diving into the world of investing, beginners can build a solid financial foundation and protect themselves against unforeseen circumstances. It provides peace of mind, knowing that you have a financial cushion to fall back on in times of need, allowing you to stay focused on your long-term investment strategy. So before you allocate your hard-earned money to investments, make sure to prioritize the creation of an emergency fund to safeguard your financial future. A common trap for new investors is the tendency to wait for the perfect moment to enter the market. The appeal of timing the market to maximize gains and minimize losses can be tempting, but it often leads to missed opportunities and suboptimal outcomes. Waiting too long to invest can result in reserve capital, which could otherwise be working for you and generating returns over time. Attempting to predict market movements with precision is notoriously difficult, if not impossible. Markets are influenced by several factors, including economic indicators, geopolitical events, and investor sentiment, making them inherently unpredictable. As a result, waiting for the right moment to invest can lead to prolonged periods of inaction, during which potential gains are passed. Instead of trying to time the market, you should focus on the principles of long-term investing and the power of compounding. By adopting a disciplined approach to investing and consistently allocating funds over time, you can take advantage of dollar-cost averaging and benefit from market fluctuations. Remember, time in the market is more important than timing the market. By getting started sooner rather than later, you give your investments the opportunity to grow and compound over time, ultimately setting yourself up for greater success in the long run. So don't wait on the sidelines. Take that first step into the market and start building your wealth today. Another mistake that you may often encounter is the temptation to invest a large sum of money all at once. While it may seem like a quick way to jumpstart your investment journey, putting too much capital into the market at once can expose you to unnecessary risk and volatility. Investing a large portion of your savings in a single transaction leaves you vulnerable to market changes. If the market experiences a downturn shortly after you invest, you could face immediate losses on a substantial portion of your portfolio. This not only undermines your financial stability, but also degrades your confidence as an investor. A wiser approach is to employ a strategy known as dollar-cost averaging. With this method, you invest a fixed amount of money at regular intervals, regardless of market conditions. By spreading out your investments over time, you reduce the impact of short-term market fluctuations and mitigate the risk of investing a large sum at an inopportune moment. Dollar-cost averaging allows you to take advantage of market volatility by purchasing more shares when prices are low and fewer shares when prices are high. Over time, this disciplined approach can smooth out the highs and lows of the market, resulting in a more stable and predictable investment experience. By resisting the urge to invest everything at once and using dollar-cost averaging, you can build a more resilient and sustainable investment portfolio. This approach not only reduces risk, but also instills discipline and patience, key qualities for long-term investing success. So rather than rushing to invest all your savings in one fell swoop, take a measured approach and let time work in your favor. Next, it's important to prioritize education and research. These foundational pillars are crucial for you to build a strong understanding of the financial landscape and make informed investment decisions. Self-education plays a pivotal role in equipping you with the knowledge and skills needed to navigate the complexities of the market. Understanding concepts like earnings per share, price-to-earnings ratios, and dividend yields allows you to assess the fundamental factors driving investment opportunities. Also, relying solely on tips or recommendations from others without conducting your own research can lead to significant pitfalls. Do not do this. While it's tempting to follow the advice of friends, family, or internet forums, doing so exposes you to undue risks and potential losses. Conducting thorough research allows you to assess the credibility of investment opportunities and make decisions aligned with your financial goals. Additionally, diving into unfamiliar industries without a solid understanding can be dangerous. Investing in companies or sectors you don't understand increases the likelihood of making misinformed decisions and suffering losses. By sticking to what you know and understand, you can mitigate risk and build a more resilient investment portfolio. Fortunately, there are many resources and avenues available for you to educate yourself, from books and online courses to financial news outlets and professional advisors. You have access to a wealth of information to enhance your knowledge and skills. In essence, by prioritizing education, conducting thorough research, understanding fundamental factors, and sticking to familiar industries, you can lay a solid foundation for successful investing. Remember, knowledge is power in the world of investing, and investing in your own education is the first step toward building a prosperous financial future. Another common mistake new investors make is diving into the market without a clear investment plan in place. Without a roadmap to guide your decisions, you are susceptible to making impulsive choices and deviating from your long-term financial goals. Having a solid investment plan is critical for success in the unpredictable world of investing. It serves as a blueprint for allocating resources, managing risk, and maximizing returns. A well-crafted investment plan provides clarity and direction, helping you stay disciplined and focused among market, volatility, and external pressures. An effective investment plan typically consists of several key components. Firstly, it should outline clear and measurable financial goals, whether it's saving for retirement, buying a home, or funding a child's education. These goals serve as the foundation for your investment strategy and help determine the appropriate level of risk to take. Secondly, an investment plan should define your risk tolerance and asset allocation strategy. This involves determining the percentage of your portfolio to allocate to different asset classes such as stocks, bonds, and cash equivalents based on your risk appetite and time horizon. Lastly, a solid investment plan incorporates regular reviews and adjustments to ensure alignment with changing financial circumstances and market conditions. By regularly reassessing your goals, risk tolerance, and investment strategy, you can adapt to evolving market dynamics and stay on track towards achieving your financial objectives. Investing without a plan is similar to someone hiking an unfamiliar trail without a map. By establishing a solid investment plan with clear goals, risk tolerance, and asset allocation strategy, you can navigate the market with confidence and set yourself up for long-term financial success. It's a common misconception among beginner investors to expect quick riches in the stock market. However, the reality is that building wealth through investing is a gradual process that requires patience, discipline, and a long-term perspective. The interest of overnight success can lead you to take excessive risks or chase speculative opportunities in search of quick profits. This mindset often leads to disappointment and frustration when expectations fail to manifest and investments don't deliver the anticipated returns. Setting realistic goals and having a long-term perspective are essential principles for successful investing. Rather than aiming for instant wealth, you should focus on establishing achievable financial objectives and implementing a disciplined investment strategy to reach them. By setting realistic goals, you can avoid the pitfalls of chasing unrealistic returns and stay committed to your long-term financial plans. Whether it's saving for retirement, building an emergency fund, or funding a major purchase, having clear and attainable objectives provides a roadmap for success. Adopting a long-term perspective allows you to weather short-term market fluctuations and focus on the bigger picture. Markets are inherently unpredictable, and trying to time the market or chase short-term gains often leads to suboptimal outcomes. Instead, you should embrace the power of compounding and stay invested for the long haul to maximize your wealth-building potential. Overall, expecting to get rich overnight is a misguided approach to investing that often leads to disappointment and financial losses. By setting realistic goals and maintaining a long-term perspective, you can build wealth steadily over time and achieve your financial dreams. Emotional decision-making in investing poses significant risks to your financial well-being. When emotions such as fear, greed, or panic control, rational judgment often takes a back seat, leading to impulsive actions that can result in losses. Fear of missing out, FOMO, may drive you to chase hot trends or jump into the market at its peak, risking overvaluation and subsequent downturns. Conversely, panic selling during market downturns can lock in losses and hinder long-term growth potential. To mitigate these risks, you must develop strategies to manage your emotions and stay disciplined. One approach is to establish predefined investment criteria, and stick to them rigorously, regardless of market fluctuations or emotional impulses. Setting clear investment goals and maintaining a diversified portfolio can also help you stay focused on their long-term objectives, reducing the temptation to react impulsively to short-term market movements. Also, practicing mindfulness and self-awareness can help you recognize and acknowledge your emotions without letting them dictate your investment decisions. Regularly reviewing investment plans and seeking guidance from trusted financial advisors can provide valuable perspective and support in maintaining discipline during chaotic times. By recognizing the risks of emotional decision-making and implementing strategies to manage emotions effectively, you can navigate the ups and downs of the market with confidence and resilience. Impatience is a common stumbling block for investors, tempting them to abandon their long-term investment strategies in pursuit of quick gains. However, surrendering to impatience can lead to many pitfalls that undermine financial success. One of the most significant risks of impatience is the tendency to engage in market timing, trying to predict short-term fluctuations fluctuations to capitalize on price movements. This often results in missed opportunities or losses as you attempt to outsmart the market. Furthermore, impatience can lead you to overlook the power of compounding, a fundamental principle of wealth accumulation. By constantly chasing the next hot investment or reacting impulsively to market volatility, you may disrupt the compounding process and limit your long-term growth potential. In contrast, patience is a virtue that pays off generously in investing. Staying the course and committing to a disciplined investment strategy, even in the face of short-term setbacks, allows you to use the full potential of compounding and ride out market volatility. By maintaining a long-term perspective and exercising patience, you can avoid the pitfalls of impatience and achieve your financial goals. Rather than seeking instant gratification, success in investing requires perseverance, discipline, and a constant commitment to staying the course, no matter the market conditions. Neglecting diversification in investment portfolios is a critical mistake that exposes you to unnecessary risk. Diversification spreads investment capital across various asset classes, industries, and regions, reducing the impact of volatility in any single investment or market sector. The importance of diversification lies in its ability to minimize the potential for significant losses during market downturns. By allocating funds across different asset classes, such as stocks, bonds, real estate, and commodities, you can mitigate the risk associated with any one asset class underperforming. In other words, diversifying investments across industries and sectors helps protect against sector-specific risks. Economic downturns or disruptions in a particular industry are less likely to have a significant impact on a well-diversified portfolio. Strategies for diversification include asset allocation, which involves dividing investments among different asset classes based on risk tolerance and investment objectives. You can also diversify across industries by investing in companies from various sectors such as technology, healthcare, finance, and consumer goods. Geographic diversification is another essential aspect of portfolio diversification. Allocating investments across different regions and countries helps reduce exposure to geopolitical risks and economic downturns specific to any single region. In summary, diversification is a fundamental principle of sound investing that helps mitigate risk and preserve capital. By spreading investments across asset classes, industries, and regions, you can build resilient portfolios that are better positioned to weather market fluctuations and achieve long-term financial success. Overall, navigating the world of investing as a beginner requires diligence, discipline, and a commitment to learning from the mistakes of others and yourself. Throughout this guide, we've highlighted common pitfalls that new investors often encounter and provided insights into how to avoid them. From the importance of establishing an emergency fund to the risks of letting emotions drive investment decisions, each point highlights the critical need for education, research, and financial planning. By recognizing these pitfalls and proactively addressing them, you can set yourself up for success in your investment journey. It's essential for you to understand that mistakes are a natural part of the learning process. Rather than being discouraged by setbacks, embrace them as opportunities for growth and refinement. By learning from these mistakes and staying committed to your long-term financial goals, you'll be better equipped to navigate the complexities of the market and achieve financial success. So as you begin your investing journey, remember to stay informed, stay disciplined, and stay focused on your objectives. With patience, perseverance, and a willingness to learn, the world of investing holds countless opportunities for those who dare to seize them. Thanks for watching MoneyMasterMind. If you enjoyed this video, be sure to check out our other videos for more investing tips. Don't forget to like and subscribe to stay updated on all our latest videos, and we'll see you in the next one.